everybody, and welcome to Masters of Real Estate. Why is Blackrock and a lot of different hedge funds buying such a large amount of the single-family home market? What do they know that you don't about the actual market and what may occur in the next 5 to 10 years? And why are they positioning themselves in that market to such a great degree? Let's talk a little bit about some of the different strategies that I think and the reasons why they may be, investing in that kind of a market and what they may see that you don't, as far as the, reasons to invest in a currently broken single family home market, right? When rates rose like crazy and affordability got squeezed, obviously it locked people into homes so they couldn't actually go out and buy a new home with the same monthly payment or the same equivalent value in the future. And so it locked people in. So they're at 4%, interest rates are lower, when all of a sudden rates are jumping to, 7s, 8s even, in a lot of different ways, which makes a lot of real estate not pencil on the cash flow side right now from a cash on cash return standpoint. It also doesn't make it work from a homeowner standpoint, from an affordability standpoint. You have a lot of issues with that affordability right now and people having trouble affording to buy a new home. So you reduce the demand through the lack of affordability, and you reduce the supply also because of the rate increases, because if they move somewhere else, they're not going to be able to afford that new mortgage payment. If you go from 4% to 8%, for the same equivalent mortgage, you just doubled your monthly payment. Now, everybody has had, also on top of that, had major increases in property values. We're still seeing increases in values right now as well, even though the affordability has, of course, taken a hit. And you're seeing Blackrock and different hedge funds where they bought 20% of the single family home market in 2023. They invested $40 billion into the real estate market, into the single family home real estate market, and acquiring properties and turning them into rentals. And of course, there's major implications to doing that. They are not looking at this from a home ownership standpoint. They're looking at this from an investment standpoint. So if something was to occur and change in the market, they may go liquidate a bunch of single family homes at the same time, flood the inventory market, cause a crash. They start to, control the market to a degree dependent on where they're buying. Now, there's certain markets that they're really focused on and certain markets that they're not. So you want to be able to understand where the majority of their purchases are going, so that way you can protect yourself even more in those markets, because when a majority or a big percentage of a single family home market starts to become owned by, one or two operators or some very large operators, their incentive is different. A homeowner might stay in a property even no matter what's happening with the valuations or the changes in the market that occur, or rental prices or things like that. The big hedge funds and Blackrock is looking at, what is this thing going to rent for? And, some of the other major beneficial factors associated with owning real estate. So, what is actually occurring right now? We've seen, prices, go up, and if they're buying more properties as well, these big hedge funds, you have a new buyer in town that is actually going to be buying a big percentage. All of a sudden, if they're buying, 20% of homes that are out there, of course, you're going to have an increase in value in that arena, depending on the specific markets that they're buying in. You're also going to have a decrease in inventory as well. We've already seen that major decrease in inventory. So it's even on top of that, it's even a harsher truth to see these other big companies taking up a giant piece, 20% of the market in certain key states as well. So it makes it harder for homeowners to buy a property when they're competing with these, cash purchases that may be getting cheaper debt as well than the majority of the public is getting, because of the way the banking relationships work, and them being able to, be the source or closer to the source of capital and getting cheaper debt for their acquisitions than even a homeowner would get for theirs. And so, some of the things that they may be seeing out there in the current real estate market, they may be saying, look, they just printed 40% of all money that has ever been created in existence in the last few years. it is going to take some time for that to permeate the market, for that to, infiltrate the market as a whole, get into people's pockets, and being able to increase property values, right? They may see the writing on the wall where the properties are an inflation hedge. In addition to that, you better believe they're not buying all cash and they're utilizing financing. And so in an inflationary environment, when you're utilizing financing, that financing can get decimated from that inflation. So they're looking at their long-term wealth building effects, just like you should be doing when you're investing in real estate in this kind of a market. If inflation does continue into the future, which I see that being, hard to not happen in the long run, short run, there could be economic challenges. There could be black swan events. The labor markets could be taking hits. Affordability could take more hits. There's a lot of things that could happen in the short term to create volatility. But if they're looking at the long term and saying the 10-year, the 15-year picture in this kind of situation, of course, they're going to be looking at, hey, what is going to happen to that debt? That debt is going to get decimated. They have an inflation hedge where property values will probably continue to increase. It may not happen at the same valuation as inflation or the same level as inflation, which is why it's important to borrow money against that debt as well, because your debt can become the asset, of course, right? And so, you have these types of issues, and if people are forced into not being able to buy a home because of affordability, then what's going to happen, right? They become renters, or they move back home, combine households. There's some percentage of a combination of combining households in different ways, as well as people becoming renters. And so we've seen increases in the rental market as well. And I predict additional increases in those rental markets as long as wages keeps up to a degree. We could be in a very stagflationary environment right now, where you have inflation coupled with a lowering of GDP, job losses, and things like that can occur. And so being able to ride out this short-term temporary storm, if it does occur, could be key. But if you are, buying property, realizing that rents will probably rise, valuations will probably rise in the long run, as well as decimating debt due to that inflation, there's three primary benefits for that occurring. Now, because the interest rate environment is the way it is, because the rates went up like crazy, and the lack of inventory is out there, like I said, we have a broken market. And so you could buy a property with very little cash flow now, but next year or the year after that, the rents will continue to rise. The property values will continue to go up. Like I said, they could go down as well for a short period of time, but in the long run, you will end up with a much higher long-term cash-on-cash return that you're probably ending up with right now in a year one when you're buying investment property in different ways, right? So you might have a lower cash-on-cash return in year one because of the interest rates that you're seeing and things like that. Of course, if interest rates come down, you can refinance those homes into lower rates. It's always, typically a good idea to do that. If you can, trade up for long-term cheaper debt, keep in mind, as long as that inflation rate is outpacing your debt rate, you're probably going to be in a pretty good space as far as decimating that debt and what that, true purchasing power of that debt is going to be in the long run, of course, right? So, and we've seen rents increase just recently over the last year or so. We've seen a 10% increase nationwide in rental values. Now, it's market by market dependent, right? We've seen places like Missouri go up by 13%. We've seen other places that have declined. So you have to look at this on an individual market by market basis to be able to determine which markets are seeing these rental increases, are seeing these types of, things come up, okay? And so you want to be able to utilize that cheap debt to be able to do that and work through the lower cash flow times to get to that long wealth term, that big wealth increase long term when you're owning these properties long term. And so I can tell you that I've probably lost millions and millions of dollars by selling homes and flipping over 1,000 houses than I ever have by actually holding. Like if I would have held these properties, I would have made so much more money. It's pretty insane. We've flipped over 1,000 houses now. So if we would have held those things for, 5 years or 10 years, the amount of wealth we left on the table by selling them is astronomical. And so being able to understand these things from a long-term standpoint is key, right? You're going to get tax benefits from holding properties and immediately get some money back from, possibly doing cost segregation studies and front loading your tax benefits into year one, right? So there's strategies there that increase your wealth. You're going to get cash flow. You're going to get equity appreciation, long term, as well as debt destruction long term too. So you're able to actually get multiple ways of creating cash flow. And if you do the math on what your true return on investment is with these different facets involved and these different ways of making money, let alone forced appreciation where you buy a property, renovate it, tenant it, or resell it, preferably tenant it, like I just mentioned about how much money I left on the table. But if you hold it long term from a cash flow standpoint, you're building in equity. So you can build in equity by doing your own workload and renovation work, or you can buy properties that are already done where you're just taking advantage of the tax benefits. You can have management in place to be able to hold these properties and not do the workload. I would highly recommend having proper property management, even an asset manager in place if you're buying pools of properties or trying to solidify your cash flow. And keep in mind, the goal in mind here is to slowly develop enough cash flow to cover all of your monthly expenses so that you can retire off of that cash flow, whether that's inside or outside of your retirement account. You can buy properties inside your retirement account. You don't really get the tax benefits associated with it, or you can buy properties outside of your retirement account and take advantage of these massive tax benefits as well whenever you're investing in the real estate market and the single family home market. So from what I'm seeing, you're seeing the hedge funds and Blackrock buying tons of these houses because they're seeing the long-term picture of rental raises over time, of a broken market right now with a lack of inventory, a lack of affordability due to interest rates and high rates. So when people are nervous about buying is the time that you want to buy. And when they can't buy, it's the time when you want to buy. Think what happens when the demand actually goes up. We might have an increase in supply because people now are putting their properties on the market. So in the short term, the volatility may be there on the upside and downside from both a valuation standpoint and a rental income standpoint. So you want to be able to be conservative when you're buying, keep lower leverage ratios than you normally would so you can ride out any storm that occurs, but realize they're positioning themselves for that long-term wealth building effect of decimating the debt, the inflationary aspects. I don't know about you guys, but I personally believe there's no way that the Fed and the government's ever going to stop printing money. It's getting exponential at this point. And so being able to put your money into assets that can give you that inflation hedge, which the property along with the debt gives you a very nice inflation hedge of decimating that debt while property values continue to rise over a period of time. So these are the things that I'm seeing that I think would be massive value for you. And I hope you guys, find ways of taking advantage of the current market. If you want to learn more about the strategies we deploy in the single family and the debt markets and things like that, come reach out to us at MathewOwens.com. That's 1T in Matthew. So MathewOwens.com. And we can talk about and set up a time to talk about all your different situations and how we can help you out. Talk to you soon. Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. 3 of the key pillars to becoming a successful real estate investor. Number 2, you can join us on our mailing list where you'll get tips and tricks on real estate investing directly to your inbox. And number 3, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.